Welcome to Future Epoch, where we learn more about our world. For most of the 20th century, General Electric was not just a company. It was an institution, a symbol of American industrial power so dominant that its name became synonymous with progress itself. At the turn of the millennium, GE was the most valuable company on Earth, with a market capitalization approaching $600 billion. Its products powered hospitals, its engines lifted aircraft into the sky, and its financial arm moved billions through the global economy. Then, in the space of 2 decades, it fell apart. By 2018, GE had been removed from the Dow Jones Industrial Average, an index it had been part of since 1907, and its stock had lost more than 80% of its peak value. By 2021, the company announced it would break itself into 3 separate businesses. The empire was over. This is the story of how one of the greatest companies in history destroyed itself. General Electric was founded in 1892, the result of a merger between Thomas Edison's electrical company and the Thomson-Houston Company. From its earliest days, it occupied a unique position in American industry, not just manufacturing products, but defining entire categories of modern life. The light bulb, the X-ray machine, the jet engine, the television network. GE built them all, or helped build them. By the second half of the 20th century, GE had evolved into a vast conglomerate. It made aircraft engines, power turbines, medical imaging equipment, and financial products. The company employed hundreds of thousands of people across dozens of countries. It was, by almost any measure, the model modern corporation. And then came Jack Welch. Jack Welch became GE's chief executive in 1981, and over the following 20 years he remade the company entirely. Welch was relentless, ambitious, and deeply convinced that GE could win in every market it entered. He acquired businesses aggressively, sold divisions that underperformed, and famously cut the bottom 10% of GE's workforce every year, a practice he called differentiation and critics called rank and yank. Under Welch, GE's market capitalization grew from around $14 billion to nearly $600 billion. Fortune magazine named him Manager of the Century in 1999. It appeared to be the ultimate proof that a conglomerate, a company doing everything at once, could be not just viable but supreme. But beneath the extraordinary returns, something more fragile was being built. Welch had dramatically expanded GE Capital, the company's financial services arm, until it accounted for nearly half of GE's total profits. GE Capital borrowed money cheaply, lent it at higher rates, and generated spectacular returns. The problem was that it made GE no longer just an industrial company. It made GE a bank. Jeff Immelt took over as chief executive in September 2001, succeeding Welch at one of the worst possible moments. He assumed the role just days before the September 11 attacks, and the years that followed brought one economic shock after another: the dot-com collapse, 2 prolonged wars, rising commodity prices, and then, in 2008, the worst financial crisis since the Great Depression. GE Capital, which Welch had turned into GE's profit engine, became its greatest vulnerability. As credit markets froze in 2008, GE Capital found itself dangerously exposed. The company had borrowed vast sums short-term and deployed them long-term, the precise model that destroyed investment banks that year. GE was forced to accept a $3 billion investment from Warren Buffett on unfavorable terms just to stabilize confidence in the broader company. The crisis passed, but the damage was lasting. GE had discovered that it was not too big to fail. Immelt spent the following decade attempting to fix what the financial crisis had exposed. He sold off substantial portions of GE Capital, seeking to return GE to its industrial identity. He invested heavily in power generation, renewable energy, and digital industrial technology, betting that GE could lead the next wave of global infrastructure transformation. The bets did not pay off. In 2005, Immelt paid approximately €9.5 billion for Alstom's power business, acquiring a large portfolio of gas turbines and power generation assets across Europe. The timing was catastrophic. Just as the deal closed, global demand for gas turbines began a steep and sustained decline, driven by the rapid fall in the cost of renewable energy and a fundamental shift in how utilities around the world made purchasing decisions. GE had bought a peak asset at peak price. Immelt resigned in 2017 and was replaced by John Flannery. Within months, Flannery announced a staggering write-down of more than $20 billion related primarily to the deteriorating power business. GE's stock fell roughly 75% between 2016 and 2018. Long-term shareholders who had bought into the Welch-era vision of GE as a permanent compounding machine watched their investments erode year after year with no clear end in sight. In 2018, GE was removed from the Dow Jones Industrial Average, an index it had been part of continuously since 1907, the only original component to survive into the 21st century. Its removal was not just a financial event. It was a symbolic statement that one of the pillars of American industry had been diminished beyond recognition. Flannery was replaced after just over a year by Larry Culp, who became GE's first chief executive hired from entirely outside the company. Culp had built his reputation leading Danaher, a disciplined industrial conglomerate, and he moved quickly on his diagnosis. The conglomerate model that GE had embodied for a century was itself the problem. In November 2021, GE announced it would split into 3 independent, publicly traded companies, one focused on aviation, one on healthcare, and one on energy. The company that had defined the idea of the great American conglomerate was acknowledging, formally and publicly, that the model had failed. GE Healthcare was spun off in January 2023. GE Vernova, the energy business, followed in April 2024. The remaining company, renamed GE Aerospace, retained the aviation and defense portfolio, arguably the single most valuable industrial asset GE had ever possessed. In a significant sense, the breakup worked, unlocking real value that had been obscured for years beneath layers of complexity and accumulated losses. The consequences extended well beyond shareholders. Communities built around GE facilities in the United States and Europe experienced waves of redundancies. GE's pension fund was underfunded by tens of billions of dollars at its worst point, creating serious concern for long-serving employees who had built careers around the assumption of GE's permanence. The Securities and Exchange Commission also investigated the company's accounting practices and reached a settlement in 2022 over allegations that GE had misled investors about the deteriorating state of its insurance and power businesses. GE agreed to pay $200 million without admitting wrongdoing. The story of GE's decline is not simply a story about bad management, though serious errors of judgment were certainly made. It is a story about the limits of a model that was once celebrated as the future of capitalism itself. The conglomerate model depended on exceptional leadership, precise capital allocation, and perpetual growth across every division simultaneously. When any one of those conditions broke down, the entire structure became a liability rather than a strength. The size that had made GE appear invulnerable also made it extraordinarily difficult to turn around when the moment of crisis arrived. The expansion of GE Capital illustrates a second lesson that goes beyond GE itself. Profit is not the same as resilience. GE Capital generated extraordinary returns for 2 decades, but it did so by assuming risks that the company did not fully understand and could not control under stress. When those risks materialized in 2008, they came close to destroying industrial businesses that had taken a century to build. The Alstom acquisition illustrates a third. Timing matters as much as strategy. A correct industrial thesis that power generation infrastructure is essential to the global economy can still produce a catastrophic outcome when the specific asset is purchased at the specific price at the specific moment in history that turns out to be exactly wrong. General Electric still exists. GE Aerospace is a genuinely world-class business, producing some of the most advanced jet engines on the planet and generating substantial, sustainable profits. In that narrow sense, the breakup worked. It liberated real value that had been buried beneath a century of accumulated complexity. But the version of GE that once represented the apex of American industrial ambition is gone. The company that employed over 300,000 people and competed across aviation, healthcare, finance, media, and energy simultaneously has been replaced by three focused businesses, none of which much resemble the empire that Jack Welch handed to Jeff Immelt at the very peak of its power in 2001. The question worth sitting with is this: was GE's decline the failure of specific leaders and specific decisions made at specific moments in time, or was it the inevitable endpoint of a model that was never quite as durable as it appeared? And if it could happen to the most admired company in the world, the company that Fortune named its company of the century, what does that say about the companies and institutions we most admire today? Thank you for watching. If you've enjoyed this content and want to see more, please consider liking the video and subscribing to the channel.